All right. Well, as our invites start rolling in, I want to say good afternoon to our friends here on the East Coast, and good morning to the rest of the country. Thank you for joining us. Buy-sell agreement shouldn't create a tax nightmare. And I'm here with my good friend and colleague, Paul Sargent from the Principal. Paul, thanks for being with us.
You bet, Anthony. Good morning, and I guess good afternoon to a couple folks out there. So appreciate you having me on today.
Yeah, Paul, this one is exciting. We've been like at this for several months, but during the month of April, we really focused on, and for obvious timing reasons, we really focused on blog articles, white papers, webinars. We're actually doing a live event on this topic tonight in Princeton, New Jersey, social posts. And this one kind of sticks, right? Like we have a sales coach here at Life Brokerage, is a gentleman named Dean Menudo. If you haven't picked up his book, you should. He was the #1 Vistage Speaker of the Year, and he always teaches us that people don't make decisions without deadlines. And Paul, this one not only created a deadline, but it kind of it was enacted immediately. Um, so, there have been important tax rulings and legislative changes over the years. But, since I've been in the business in 1999, there were some big ones like, changes to Section 199A that affected business owners, the corporate tax rate in the Tax Cuts and Jobs Act in 2017. But this one targets a common, widely used planning structure, and it affects both legal valuations and life insurance planning that attorneys and insurance professionals just aren't addressing, right? So it not only creates a deadline, but it applies immediately, and it isn't tied to future legislation or phase-in. So, Paul, we have a little bit against the norm here, where we would typically go through methodically a bunch of different slides. But in today's webinar, what I thought would be that I would start asking you some subject matter questions, with you being the subject matter expert, that kind of give the audience like what's in it for them, right? Another common principle of our sales coach, Dean Menudo. Like, why would you attend this seminar? How can this help you? How can this help your client? And what does it mean? And then get into like some of the mechanics. Like, what would you do in this scenario, Paul? Talk me through this particular strategy. What would you do in lieu of a stock redemption plan? So we've carefully crafted several questions. When there are visuals to apply, we will apply them. But for the most part, this will be a Q&A. And please, anyone from the audience, put your questions in the chat. We've gotten pretty good at weaving them into the discussion. If we don't get to it through our discussion, the natural flow of the slides, we'll save them for the end, and we'll start peppering Paul with the toughest questions we could possibly ask. Now,
Perfect.
I want to just warn everyone. Paul dined at our favorite Philadelphia restaurant last night called the Saloon. It's a classic Italian steakhouse. I'm almost certain he overate, was probably overserved. So keep the questions to a reasonable level, and we'll try to pull the best from him on this morning after the Saloon hangover.
I will plead the fifth there, Anthony. I will plead the fifth. So
All right, shameless plug there to the Saloon restaurant. So I'm going to share some slides here. Paul, are you seeing the presenter slide, or are you seeing the
yep,
full slide?
I'm seeing the presenter slide.
All right, so I'm going to do a quick swap. I
There we
can
go.
never get that right the first time, so I always seem to ask. Um, Paul, tell us just a little bit about yourself, and then we're going to get into it.
Yeah, I've been with Principal almost 20 years now. I'll be 19 this summer. Really, my focus has been historically really in the insurance planning space and really specializing in planning for business owners, key employees, and executives, just like I dreamed of as a young child. It's one of those things that we do really well here at Principal, and my focus is really helping, producers, advisors, and folks on Anthony's team really educate around what are we seeing, what are we hearing in the business markets, what planning opportunities exist, and then how do we incorporate, risk management insurance solutions into those different planning opportunities. I'm based in Des Moines, Iowa, where Principal is located, but I work with advisors all across the country. And really, my focus, along with the education, is helping be that additional resource in front of clients. I do a significant amount of point of sale work. So I'm sitting across the table with advisors, talking to business owners day in and day out. So really the goal today is to kind of maybe share a few of the ideas around, what happened with Connelly, what are the planning opportunities, and share some real world language and examples that hopefully everyone on the call today can take away and put into action right away.
Yeah, I'll add that, as a BGA, Paul has become a secret weapon. He is not sharing revenue. Principal is not reducing your compensation. Life brokerage is not reducing your compensation. Principal doubled down on the business market. The resources are somewhat endless when it comes to the business market and the administration of the business solutions that they implement. And Paul is amazing. We'll speak to clients advisors, the advisor, the BGA, you name it. He is the secret weapon that has single-handedly driven tens of millions of dollars of premium for life brokerage. Some really, really big business cases. Um, so Paul, here we go with that acronym WIIFM, right? This is that old school radio station. What is in it for me? So, what does the advisor want to take away here, and why should they tune in? Um, I would say first and foremost, you want to stay ahead of legal and tax traps, right? You want to learn how recent rulings like the Connelly case could quietly derail a plan, right? Business owners think that they have a plan. Well, rulings like this completely upend those types of plans. You want to discover modern structures that can do more, right? Traditional entity redemptions are now, somewhat outdated. They may still apply in certain cases, but it's just hard to justify from this point forward, like cross endorsement and like manager managed LLCs. That seems to be, Paul, such a buzzword and so complicated to get your head around. But what we want to do today is really simplify that. And Paul, you've done a great job simplifying you using the LLC structure, which is right, seems to be this buzzword that is hard to comprehend. But just kind of peeling back the layers to just bring out the clarity and the simplicity around it for us today. You want to add more value in your meetings, right? You want to get to a solution in fewer meetings. So if you're gaining ready to implement conversation tools, you can uncover some of these issues for your clients, and then you will be rewarded, likely with a product solution or a fee, and you can then become the subject matter expert that coordinates the legal and tax and insurance strategies all together. The fourth reason why you want to be here today is you want to bridge the retirement and succession plan. Um, right, permanent life insurance, when structured smartly, can serve dual purposes. You're going to see some techniques that we have employed at Life Brokerage on a cross endorsement split dollar that's going to kind of work dual purpose, supplemental retirement for myself and Adam, and fund a buy sell agreement. And then you want to get into, you want to be familiar with some real world case studies and planning blueprints. So you're going to walk away with some case studies, some checklists, and some tools on how to implement. Um, Paul, did I miss anything right in the WIIFM?
No, and we'll talk also, Anthony, about who are the right clients to talk to. We're going to talk about some approach language as we build into this. So the goal with our conversation today is really to take actionable items
Yeah,
away, and then obviously leverage the resource that Life Brokerage brings to the table in addition to what we do here at Principal.
yeah, well said. Well said. All right. Question number one, Paul. The recent Connelly case. For those less familiar, can you summarize the core issue at the heart of the ruling and why it has such far-reaching implications?
Yeah, and I think, oh, go
But
ahead.
but before you answer that, Paul, I just want to remind everyone that, as Mike Tyson eloquently said, everyone has a plan until they get punched in the face. So Paul, talk to us. What went down?
Yeah, so this is a classic example of, clients who thought they had done all the necessary planning and come to find out that not necessarily following the exact parameters of their buy-sell agreement ended up triggering this scenario, which eventually led to a Supreme Court ruling. We had a couple of brothers who owned a successful business. They had funded a buy-sell agreement, a stock redemption entity purchase agreement with life insurance, all the things that we as financial professionals would advise them to do. As a part of that agreement, when it came to determining value of the business, there was a provision that said they should be doing this every single year. As the kids would say, spoiler alert, they weren't doing that. And so when one of the brothers died, we now had to deal with the fact that they were not following their specific buy sell agreement. So if we jump to the next slide and kind of look at the visual aspect of, we had a disparity in ownership where 77-23. When Michael died, they had a $3.5 million life insurance policy that was corporate owned on his life. The intention was to utilize those proceeds to buy the shares from his estate, and exactly what a traditional buy sell agreement arrangement would do. Well, the problem was because they had not followed the agreement, they basically pegged the value for the buyout at 3 million. So the business gave a $3 million check to his estate to buy the shares back. As a result, the family basically said, "Hey, since we sold the business for $3 million back to the brother, we're going to file in the estate tax return that the business was worth $3 million." Seems like a fairly logical transaction to take place. Well, the IRS came in and actually said, you know what, we don't necessarily agree with that. We see that there was an influx of 3.5 million of capital that came back into the business at Michael's death. As a result, we're actually going to increase the value of the business by that $3.5 million. So as a result, Michael's 77% of the business wasn't $3 million. The IRS actually said it was 5.3. So at the end of the day, because there was not clear definitive language, because they weren't updating their valuation method, the IRS was free to determine a fair market value come estate planning time. And as a result, it triggered roughly additional $1 million of estate taxes that the Connelly estate had to pay back. Of course, the family paid that estate tax liability. And the next thing they did was they sued. They went to lower circuit courts, eventually the Eighth Circuit Court, and eventually up to the Supreme Court. And I don't know if anybody follows the Supreme Court, but they're not 9-0 on very many things. They sided 9-0 with the IRS in this case. So when we talk about the going forward, what does this mean? It means this is the law of the land. The interpretation is clear that corporate-owned insurance on owners funding buy-sell arrangements fits in this category, and the IRS will deem it as an addition to business value, not as a redemption of shares transaction. So for everyone out there who has these buy-sell arrangements that are entity purchase, they are essentially in the crosshairs of the IRS when it comes to valuation determination when it comes time to file their estate taxes.
Paul, let me get this straight. So since 2005, the industry has been using the blunt BLOUNT versus commissioner case
Yep.
that describes the obligation to redeem the shares treated as an offsetting liability. Why in the world, if the shares were redeemed in this particular case, why in the world would the IRS completely disregard that liability and increase the valuation for Michael?
Logic doesn't always fall very well in DC. They basically determined it as it wasn't a true liability, but rather it was a separation of the two different the company to two different parts.
Mhm.
So it literally did not make sense in any way, shape, or form for all of us who understand that Blount case from years and years ago, and to what we see as a normal practice in buy sell plan, that money comes in and immediately flows out as a redemption of shares. So again, part of it is lack of education, I think, for those who are fighting this, case in DC, but also the fact that the ambiguity and the fact that these two individuals did not follow their buy-sell agreement left the door open for the IRS and ultimately the Supreme Court to find a way to say that this obligation really isn't as it is intended, and we're going to determine that there's additional estate taxes owed.
Wow. What a what a groundbreaking ruling that creates deadlines, um, is a door opener, coordinates the work of attorneys, valuation experts, and insurance professionals, and provides a service to the customer, who may be completely blindsided by this particular ruling. So, Paul, if you are that facilitator, right, and you are looking to bring together the attorneys, um, how should financial professionals and attorneys approach the existing entity purchase agreement in light of this ruling?
Yeah, and I think right now, to be honest, timing is really really good, as we see a lot of business owners who are reconciling 2024 financials. They're looking at that, how last year's revenues impacted valuation, timing wise, of saying, hey, we realize you just got done with your 2024 taxes. We also want to make you aware of a decision that happened last year that likely impacts a lot of buy sell agreements. When was the last time you, as a business owner, had a third party take a look at your buy sell arrangement to make sure that it is in accordance with current tax law? And ultimately, all we're trying to do is say, hey, can we get a set of eyes to look at your agreement to make sure everything is accurate, to make sure it's the right type of agreement, to make sure that all the issues we just outlined with Connelly are impacting their particular agreement. Now, when we're talking to CPAs and professionals, there's a ton of white papers. We at Principal have put out great, applied knowledge collateral that is in the language of attorneys, in the language of CPAs, that I would strongly encourage everyone on the call to utilize that and share with those centers of influence. Because as many of you wouldn't disagree, there's a lot of tax professionals and a lot of attorneys out there who aren't experts in this field, but have clients who may be impacted by this decision. So sharing that knowledge, giving them the opportunity to help you with those discussions with clients, is a really powerful thing, and especially as we're doing those reviews right now. As we talk about, the Supreme Court ruling, anytime you hear a definitive 9-0 Supreme Court ruling, that should get everyone's ears to perk up. And when we talk about these entity purchase agreements, to Anthony's point earlier, this is a very common practice. You will see these agreements out there. Any business that typically is going to have more than three or four owners, the typical structure is going to be this, vanilla entity purchase agreement. So it gives you the opportunity to go out and look for these particular business owners that have these corporate stock redemption entity purchase agreements, and talk about doing a review of those documents to make sure they're not impacted.
Well said. So kind of playing right into right where you left off there. Is there a practical way, Paul, for advisors to assess whether the client's current plan is vulnerable?
Yeah, so there's a lot of different ways that we can certainly address that. And again, very very few. I mean, there's obviously some attorneys and CPAs out there who are very in tune with this. I would tell you that we've also built our team of resources that can be a trusted partner in this. We've been doing complimentary informal business valuations and complimentary buy sell agreement reviews with our own staffed attorneys and CPAs. We've been doing that since 2007, early 2008. We do about 1,500 buy sell agreements, business valuations every single year, and about 400 buy sell document reviews. And we do not charge a fee for those services. It gives them a complimentary service to have a third party, a disinterested third party, review those documents and check them against the new best practices. The goal of the buy-sell agreement review is not to talk about how the attorney who drafted it had no idea what they were doing and it's complete garbage. It's, hey, there's been significant change. We want to make sure that your agreement matches what we consider best practices based on the 400 buy-sell agreements we review every single year. And we're going to give you planning considerations as a result. While we're doing that, we'll also get 3 years of business financials, and we'll do a complimentary informal business valuation to help establish that value for planning purposes. And the idea behind that as well is oftentimes if there's insurance, they're underfunded because their business has grown the past 5, 10 years. And we need to incorporate new risk management tools, whether it's life insurance, disability buyout coverage, or simply, as we'll talk about here in a few minutes, is there a need to retool the entire agreement and the entire amount of insurance based on this Connelly ruling? And as I mentioned earlier, our team is very hands-on. We're there point of sale with you and the client. In addition to myself, our CPAs and attorneys will also do Zooms, client calls with you and the client's attorneys and CPAs, and we do not charge fees for that service. So you've got a arsenal of resources behind Life Brokerage and Principal that you can put the right experts in front of your clients. So you don't have to be the expert. You can rely on the resources that we've built here at Principal to do all of these things as a result.
Paul, I will echo, providing this service is invaluable, right? But that's only step one. So
Yep.
when we were early in engagement with Principal in this strategy, and this dates back all the way to like 2011, where we started to work with you in this type of engagement. The reports are amazing, right? They're beautiful. I circled right this informal business valuation and buy-sell review. They're beautiful. But if the advisor cannot communicate the content of that report, sometimes it never gets sent to the customer. Sometimes it never gets reviewed. The advisor is a bit overwhelmed. I think the most important part of the process is that once you submit back to Life Brokerage this report, we then schedule a call with your team and the advisor to walk them through what is contained in that report. And then step 3 is to further engage with the client and their client, right? So the financial advisor and their client and possibly the advisor. So there's an educational process along the way. It's not, here's your report, good luck. Let us know what we can do to help. Oh, by the way, here's pricing per million. No, they handhold you throughout the process. Again, no fee, no commission split, no obligation. Principal gets their fair share of the business. Because of all the work that they're doing for you, you're going to want to drive business to their product once the product is introduced, whether it be term, permanent, VUL, IUL, disability. They have the full suite of service, but it is not here's your report, good luck. It is an educational process, and you will look really, really smart once your first couple sessions of learning this report with Paul and team are completed.
Yeah, and I would just add, Anthony, we're really focusing on the entity purchase planning as a result of Connelly. We review all types of buy-sell agreements, whether it's cross-purchase, stock redemption, one-way, wait and see, trustee buy-sells. It is not limited to just talking about Connelly. We do reviews of all those documents as well. So, keep in mind it is a broad-based planning tool.
Yeah, and speaking from experience, it's not just okay, you fell into the Connelly trap. As simplistic as partner 3 didn't sign the
Yep.
document, or your stated value of the company is 7 years old. You were supposed to update it at every annual shareholder meeting. Well, I don't know about the folks on the call, but we don't hold an annual shareholder meeting at our company. I can't imagine many, and we're in the business. I can't imagine many folks actually do. Doesn't address disability, or the policies aren't referenced. The offsetting liability isn't described. There's a whole host of things that can go sideways. And I am confident when I speak to a producer that we can help their customer in one way, shape, or form. It may not lead to revenue immediately, but I am confident that we can add value every single time we get a complimentary review completed or an informal business valuation. So Paul, this Connelly seems to be this like tax bomb about to ignite. What are the best practices emerging from this case to help mitigate future estate tax exposure?
Yeah, a lot of it comes down to we are seeing a significant amount of these buy sells simply being retooled and restructured into different formats. Well, we're going to talk through a couple of specific examples utilizing an insurance LLC and some additional ways we would do, cross purchase agreements. But we are seeing clients who are looking at this and saying, based on the ruling, we have a consideration around estate tax exposure. This is not going to help our cause. We need to figure out how to move out of our existing agreement and do some additional planning. Now, ancillary to the buy sell planning, there's further discussions around gifting, there's further discussions around traditional estate planning, which obviously will lead to additional revenue opportunities. Specific to the businesses, I mean, with the best practice that we're seeing a lot of businesses with these entity purchase agreements is really looking at retooling to one of the alternative structures. And while we're really focused on the estate tax exposure piece of this, one thing that can't get lost in Conley is it's not just a impact to those business owners who are in a potential estate tax exposure situation. When we think about where Conley came in and said it's about value being increased by insurance proceeds. If Anthony, Adam, and I are three business partners and we have a stock redemption plan and our business is worth 10 million, we each have, a third, a third, a third. So if I have $3.3 million of life insurance on me and I die, and there's an obligation that Anthony and Adam would buy those shares back from my surviving spouse. My spouse could come in and say, well, actually, the IRS says that 3.3 million of insurance you had on my husband is now adding to the value of the company. So the business value is not 10 million, it's actually 13.3. You owe me one third of 13.3, not one third of 10 million. So even though it's not an estate tax consideration, I think we will continue to see litigation around that increase of value when it comes to insurance proceeds that will trickle down and create other planning considerations. So there's a lot more than just the estate tax exposure that goes into Conley. So it's more important that we start thinking about those alternative buy sell designs and how we can talk about implementation there.
Paul, I can't imagine, putting the estate tax aside, I can't imagine if a surviving spouse has been paid at quote unquote fair market value for the shares, that if she doesn't connect with an astute advisor who starts poking around and probing and suggesting that the IRS sees the valuation at a very different number that she was
Mhm.
paid. I can't imagine she's going to go away quietly, or he is going to go away quietly in light of this IRS alternative valuation.
Yeah, I would completely agree. And again, part of that is also how these agreements are drafted and establishing value, that we talked about where Conley didn't do those things. So as we look at those reviews, making sure that those documents are updated, current, and being followed, particular to valuation methodology, is going to be absolutely paramount to having good long-term planning.
Yeah, well done. Well done. All right, Paul. I have another question. So you're on the call. Before we get really technical and getting into the manager managed LLCs, um, what are some proactive steps an advisor can take right now to help clients manage and preserve basis more effectively in a business transition? Here's the old basis question.
Yeah, I think there's, a few different items, and I'll be curious, AJ, to hear your thoughts on this as well. But I think as we start looking at, you know, moving dollars in a business, talking about looking at non-qualified planning, looking at how we're transitioning shares down, if we're looking at interfamily businesses, there's a lot of thinking about the end game in mind for business owners as they look to transition their business. So as we think about basis planning, buy sell is certainly one portion of that. But as we look at capital contributions, as we look at different ways for business owners to really extract value from their company, there's a lot of planning considerations. And I know, we're going to have an attorney this evening speak to us as well. I mean, Anthony, I'm curious how you've seen this in practicality used as well, because I think we are also very focused on that preservation of basis, particular to the buy sell planning. There's obviously a lot more that I'm sure you've seen be done in the living aspects of a business as well.
Yeah, I would say this, Paul, just high level. When I came into the business in 1999, financial service, business like a BGA or just our business, for example, right, didn't really have enterprise value. It was more of a lifestyle business, right? The owners, made a nice living. They ran through all their, quasi personal expenses, meals and entertainment, right? It was a lifestyle business. There was no value, right? There was no enterprise value to it. Now, fast forward to today, and entities like ours are selling at 10 to 15 times cash flow. So the exit is very real. There have been a lot of liquidity events in our field, and our field is no different than construction, um, other financial services, software, engineering. I mean, the monetization of business is so common nowadays that you have to pay attention to preserving basis, right? When do you take the election? Um, what type of structures like cross purchase or insurance LLCs can you use to increase your basis through the use of a mandatory buy sell obligation? So we're going to talk in detail tonight, but basis needs to be considered in every aspect of the plan. It's just from my perspective, Paul.
Yeah, I would agree. And as we'll talk through some of these buy sell strategies that we've pivoted away from the entity purchase, one of the biggest downsides of an entity purchase agreement was giving up that step up in basis in favor of a more simplistic approach when we have a large group of owners. One of the strategies around the insurance LLC, the managed LLC that we're going to talk about, helps us really keep that simplicity of a entity purchase agreement while very much to this point creating that basis protection, that step up in basis that a traditional cross purchase agreement would give us without the complexity of
Yeah.
30 policies on 6 different owners.
All right, Paul, you kind of walked us right into the next question. Um, we often hear about these manager managed LLCs, business continuation LLCs, insurance LLCs. They're all the same thing, right?
Yep.
In operational context, but not always in buy sell planning. Can you explain how this structure supports better succession planning and creates simplification and preserves basis, like we just talked about in the prior question set?
Yeah, and I'm a very visual learner, so I know we've got a slide that kind of puts together a nice schematic. I know there's a lot of moving parts to this, and traditionally this is a more complex scenario than you would see in a normal buy sell planning because we are incorporating a separate entity. When we utilize the insurance LLC, the business continuation LLC, we're essentially establishing a separate entity and a separate LLC from the operating business with the sole purpose of that LLC is to hold insurance to fund a buy sell agreement. When we establish the LLC, we are establishing it where we have one policy on each individual owner. So, unlike a traditional cross purchase where everybody owns it on each other, we're only establishing one policy per individual. Now, each of the owners is going to make a contribution to that LLC, and that contribution is going to go pay premiums. On this scenario, we have 3 owners. That contribution is going to go pay premiums on the other 2 owners. And when we talk about why this creates a separation around Connelly, we have a separate entity that is not the operating entity which would receive the insurance proceeds. So if one of the partners dies, when the insurance proceeds pay out to the business continuation LLC, there is an increase in basis via a special allocation to those surviving business owners. They then utilize those proceeds to buy out the shares from the estate of the deceased owners and effectively creating what's similar to a cross purchase arrangement with that increase in basis. So, because we're keeping those operating entities separate from the insurance entities, it helps us avoid that Connelly conundrum of increasing the value of the operating business because the proceeds aren't paying there. They're paying to the insurance LLC. So it does give us some flexibility around, having the value tied outside of the operating business. It gives us simplicity because it's one policy per individual, but also gives us, more long-term strategies. And we'll talk about here in a second around what happens if everybody lives as well. So I'm going to pause real quick, and AJ or Anthony, any questions around, how it's initially structured and kind of what this looks like?
So the objective, just so the objective in mind here, Paul, you wanna minimize taxes upon a subsequent sale by increasing basis, right? You have fewer policies that are needed. You can avoid transfer for value issues later on in life if you want your policy back or you're moving policies around. There's a lot of really good attributes to the business continuation LLC, right? For the purposes of this particular case, walk us through a third partner in owner A, owner B, owner C, and I call it a $10 million valuation. How much insurance is purchased through the business continuation LLC per policy? And then how do the mechanics work? Assuming 3.33 million of death benefit comes in on owner A. What then happens, Paul? Kind of layman terms using some real math.
Yeah, so you're putting me on a spot here without a calculator here for my math. I'm just a small town Iowa kid with the math, but ultimately we're looking at a 50% allocation to the surviving beneficiary or the surviving owners. So when owner A dies, that 3.3 million comes in. There's a 50% allocation back to surviving owner B, surviving owner C, and effectively increasing their basis by call it that 1.78 million dollar number of that $3.3 million valuation. So we get the same benefits that a traditional cross purchase arrangement would do without all the complexities of multiple policies. And so when those proceeds then pay out to the insurance LLC, there's a separate underlying agreement in the operating business that says the owners are going to buy out the shares from the surviving estate and they can utilize those proceeds in order to do it. So we are looking at this as basically a way to have a functional cross purchase arrangement without necessarily having the complexity of multiple policies, multiple ownership, because we are utilizing that special allocation of the survive or the deceased owner A's $3.3 million life insurance policy proceeds.
So in that example, Paul, would each surviving owner pick up 1.66 million, which is a half of the 3.333 million of death benefit in basis?
Correct.
Makes sense, right? So then a subsequent sale of the company now has offsetting basis of an additional, 1.66 million.
Correct. Yep. So again, functions, again, we're all familiar with the cross purchase arrangement. It gives us a lot of those same benefits without the, complexities of multiple policy ownership and insurance.
Very clean, very effective. Thank you, Paul.
Yeah, and I would say one of the considerations too, Anthony, around this, and there's a few things you mentioned the transfer of value. There's considerations around establishing a true partnership to avoid any potential transfer for value issues down the road. But there's also going to be legal setup fees. We are establishing a new entity, so there is a cost associated with this. But I would tell you, in the cases that we have worked on, the real life scenarios, there's a lot of moving parts and attorneys are looking for support. So we've had our attorneys on the phone, on Zoom calls with clients and their attorneys to talk through the right setups of these. And what that does, it helps eliminate confusion down the road, and can ultimately, with our sample agreements, help maybe minimize some of that setup cost and fees that attorneys are going to charge as we establish these new types of entities.
Well done, Paul. Okay. Mind if we get into a real case study?
Yeah, absolutely. We see, and again, every case is unique, and we don't typically see the normal business of, hey, we have 5 owners and everything's clean and easy. We all own 20% of the business. Businesses are more complicated than that. And so, one of the things that we do take for our approach is really looking at a holistic view of what's their goal, what's their objective, what do they have currently in place. In this case, in particular, was very unique. We had a very successful, organization with a business valuation that was roughly $100 million. They had multiple entities, and inside of these multiple entities, there was different ownership percentages with different individuals. So as we were doing the deep dive with our attorney, with our CPA, with the advisor, and the client's attorney, we were basically saying, here's what the snapshot is today. Here's our concerns with valuation, with Connelly. What do you want to see going forward? And the biggest thing they told us was simplification. We realize it's a little complicated, it's not normal. What can we do to simplify the process? So we really engaged them talking about the insurance LLC and went down that route. The attorney really globbed on to that particular concept, but knowing there were multiple entities with different ownership structures, we knew we had to be creative. As a result, we actually implemented two different insurance LLCs that managed different parts of the business because there were different entity structures, different tax IDs that had those different ownerships. So we simply established two insurance LLCs. And if we flip to the next page, once those were established, we looked at that valuation and we needed about $80 million of additional life insurance coverage to fund their buy sell. Now, at the time, we're only looking at a term insurance sale, which again, 230,000 in term insurance premiums, nothing to, cry home about. It was a good, nice opportunity. We're also looking at funding their income protection, their disability components of these businesses as well. And so we're still engaging them in that conversation. All of this was in hand, in lockstep with our attorney, with the client's attorney, with the advisor team, with our underwriting process. So we wanted to make sure it was a very seamless process for the end customer, knowing that their goal was simplification. So great case study of how we, pool resources together, implement these kind of solutions. And the question I get often is, well, how long did this take? It was about an 8-month time horizon from initial discussion to getting documents drafted, getting underwriting done to completion. So it wasn't something that came overnight, but was one where we found, great value in partnering with the advisor, the CPA attorney, and our team as well.
So Paul, just to kind of wrap on the LLC, how do they compare to traditional structures when it comes to control and protection and planning flexibility, such as cross purchase or entity purchase type of?
Yeah, I mean there's obviously some simplicity factors that lean more towards the entity purchase. When it comes to control and protection, it isn't an LLC. I mean, you are looking at the ownership of the LLC being allocated as the same as the operating business. So control really doesn't change. As we look at the operating agreement inside that LLC, it's going to look a lot like the traditional buy-sell arrangement that we would normally see. When we talk about the long-term benefits and flexibility, we touched on it earlier, but what happens if everybody lives? The benefit of having this is that because we have insurance held inside of this insurance LLC, we can essentially terminate that special allocation. We can terminate the business continuation LLC, and the life insurance held, whether it's term insurance, whether it's permanent cash value insurance, can then be distributed out via liquidation to the insured, and they can own the policy themselves outright. And because they already insured, that's an exclusion for transfer for value. So it can also create a long-term, whether it's estate planning play, whether it's a retirement income play, it gives flexibility long term that we're going to bet on these owners living and not passing away in the business. So there are a lot of controls that are still built in. There's a lot of flexibility, and ultimately there are exit strategies other than death inside of these life insurance policies.
Yeah. The cross endorsement is my favorite when the right number of partners are allowable, followed by the LLC. Just personal favorite. So Paul, any compliance or administrative drawbacks that the advisors and the attendees on the webinar should be aware of when recommending this route? I mean, is it complex? Who helps out here?
Yeah, so definitely incorporating the client's CPA and attorney. We obviously need to establish a new entity. As I mentioned earlier, there's some legal fees that go in with that. The special allocation is really where having a CPA that understands the impact of making sure that we protect that increase in basis by appropriately allocating that special allocation of those contributions into the insurance LLC and also at death. Those are the important things that we make sure. And again, our CPAs are always happy to engage with a client's CPA as long as you, the advisor, are on the phone to help educate them on that particular step in the process. Those are the real two things when it comes to the actual agreement. And then I would also say when it comes to looking at the actual underlying buy sell, making sure that there are mandatory triggers. Anything we would normally see in a traditional buy sell arrangement, making sure it mirrors those same set of parameters around having a well documented determining valuation correctly, and then, as you mentioned it earlier, Anthony, it's reviewing that every single year. Things change. We want to make sure that this is not a set it and forget it type of approach. Those are the things that you as advisors on the call need to be educating clients and professionals about, is this is a long-term solution that needs checked in on every single year.
Amazing. All right. A little earlier, we talked about a dual purpose planning strategy that addresses both retirement and succession. Often difficult to execute, sometimes difficult to get your head around. How does the cross endorsement using permanent life insurance address this challenge, Paul? Because as I mentioned, with the right amount of partners, this is my favorite strategy.
Yeah, and I would certainly agree. And with the cross endorse split dollar, maybe we'll start as what it is, how it works, and that maybe we'll talk about where we're really benefiting with this kind of arrangement. So unlike a traditional cross purchase arrangement where Anthony and I are partners, I buy a policy on him, but I'm only assuming super preferred non-tobacco rates, and he buys a policy on me, which after saloon last night, I might be somewhere between a standard and a table two. We're buying those policies on each other. And that's a traditional setup, very easy. Where there becomes some complexities is when you do have a couple of things that go along with that. When there's a disparity of ownership percentage and valuation, maybe there's a disparity of age where you have one partner who's significantly older and now premiums are much higher for one than the other, but also thinking about when we start adding additional owners into the mix. Traditional cross purchase works really well when it's just two partners. When we start adding third partners, then it can add again one policy on each of the subsequent owners. What I like about the cross purchase arrangement, if we have three owners, all we're simply doing is we are buying policies on ourselves, and then we are endorsing a portion of the death benefit to the other owners to cover the obligation of the buy sell. So, like a traditional split dollar arrangement, I'm effectively renting that death benefit to my other business partners. And we do that via a simple annual 1 year term rate or table 2001 rates, where the other participants in the buy sell are essentially reporting that as income. So, we look at this as a structure around I own my own policy. If something happens to me, whatever is owed to my surviving business partners is paid out to them. And anything left over be paid out to my estate, to my family. But also, what happens if we all live? Because if, Anthony, if you, Adam, and I are all business partners, we're all young, we're all healthy. What happens if we decide to exit, we decide to live? If I own a policy on you or Adam, I got to figure out how do I transfer this over? What's the cost of doing that? What's the tax obligation? And vice versa. And specifically, if we fund these with permanent life insurance, that becomes very messy and could create some unnecessary and unwanted tax liabilities. When I own my own policy, we simply terminate the split dollar agreement and I own the contract. So, where we traditionally would fund with term insurance, you can still do that, but we find there's a great opportunity to fund these types of arrangements with permanent cash value accumulation life insurance with the goal of if one of the owners dies, that's fine. We have death benefit that will cover that obligation, but we're going to bank on everybody living. And if I live, I now have created a personally owned tax deferred bucket of money that I can use as a source of retirement income after I transition or sell out of the business. So there's a lot of flexibility in this type of design by having me as the owner of my policy and having the endorsement of the death benefit to cover the liability in the buy sell. And one of the great things about working with Principal on an opportunity like this, not only do we have the agreements and the split dollar component handled, we will also help with the annual reporting. So when a plan is with Principal and there is that annual 1 year term rate that needs to be reported, we have a dedicated administrator assigned to every one of these plans who will send out an annual summary with that accounting that then can be used with the client's CPAs to make sure that it's being handled correctly on their end as well. So we look at it as a full turnkey solution here at Principal when we implement these types of plans.
All right, Paul. I like to I like to bring this back to just kind of some layman terms, right? So a cash value life insurance policy is nothing more than a property. It's an asset, right?
Correct.
It's no different, Paul, than you owning a lake house in the Ozarks, and you're getting all the appreciation, building all the equity, and you subsequently rent that house to me to use for a month in August of 2025. For that month, that's my property, right? You can't come there, you can't sleep in the bed, you can't mix up, your kids' toys with my kids' toys. It's my house for the month. And that rent is representative of the 1 year term rate you just described. It's no different than if you and I were partners and you rented me the death benefit on your cash value whole life policy or variable life policy or equity index, whatever type of policy that you own. I am only paying for the usage of that policy for that period of time. And at the end of the day, when our rental agreement is up, it's up. It's your house in the Ozarks. You get to move your stuff back in. You get to sell it if you want, rent it to someone else if you want. It's your property. It's no different than this cross endorsed cross purchase buy sell planning tool, right? Where you buy a piece of you buy an asset, cash value life insurance, and you rent it to your business partner. There's some documentation. There's a split dollar form that Principal will require you to fill out. You're going to want to address it through the buy sell agreement. But again, just like rental agreements that you get from your realtor, you're gonna get a cross endorsement split dollar document from your insurance company, and it's somewhat easy to follow. In particular, when you have the right advisors and you bring all the advisors to the table. Paul, how'd I do with that analogy there?
I think that's great. The only difference would be is I don't have to have a key for the liquor cabinet for the buy sell as I would for the house in the Ozarks. So
Fair. All
you're
right.
in a great spot.
That's fair. Fair. So, as we approach the top of the hour here, maybe just a couple, final questions, Paul, to have some fun with. What's the biggest misconception you hear and all the plans that you've looked at and all the business owners you've met with? What's the biggest misconception you hear when it comes to using life insurance in a business plan?
Well, I think one of them is, purely life insurance is a death benefit only type of transaction. We've talked a couple of different times today about we really want to plan on owners living. We obviously want to mitigate risk of using insurance proceeds for the untimely death, but we also want to think about the long-term strategies around how life insurance can be a tool for whether it is creating an inside transition, whether it is for supplemental retirement, whether it is for long-term estate tax planning. There's a lot of additional reasons to utilize permanent life insurance in business planning rather than just default to term is cheap, term is easy, and nothing wrong with term. But there's a lot of misconception that it always has to be a term insurance solution to cover a need for a client. And so we have a lot of those discussions with business owners about really long-term planning. And there's obviously meaningful opportunities to talk about, whether it is retirement planning, estate planning, as we're talking about buy sell planning, because they are one and the same. Business owners will retire at some point in time. They will leave their business at some point in time. They will have an estate plan they need to deal with at some point in time. Now, how they plan for that is dictated through how they're having those discussions with you, the advisor, today. But permanent life insurance is a great way for a lot of business owners to be thinking about those long-term strategies.
Yeah, for sure. For sure. You immediately think of term. Oh, I'm gonna, and everyone sets the duration of term to how long they think they're gonna be in business, right? And it's always
Yeah.
like, yeah, I think I'm gonna do this for another 10 years. I'm gonna buy a 10-year term. Well, there's usually a better way to do this, provided you have the cash flow and the insurability and right everything else to kind of go along with it. You creating buffer assets, using the asset as a leverage tool for banking or working line of capital, growing it as a fixed income alternative. Like there's so many things you can do with it, Paul, that we won't get into now, but we cover in prior webinars extensively when it comes to the different uses of cash value life insurance, not to mention a sinking fund or a vehicle to buy out a partner during life, right? They step away from the business. They don't die to exit or become disabled to exit. The majority of the time, your partner exits alive, right? You have to figure out what to do and how to create a redemption for their shares.
Yeah, and I would just add one last comment to that too. We talk about, retirement, we talk about death, we talk about disability being triggers to exit a business. The one that is the least common that I would personally see is that business owner who says Monday's my last day and I'm 100% out. That almost never happens. Usually it's a transition, it's stepping slowly away,
Yeah.
it's a reduction of shares over time. So this myth of tomorrow's my last day and 100% goes to somebody else, that is not a normal planning process. So again, all the reasons that Anthony just talked about using those insurance to kind of leverage a long-term buyout plan.
Well said. So, Paul, staying along those lines, what do you recommend presenting, or how do you recommend presenting this concept to a business owner who's really focused on protecting their family and not so much their partner or business, right? Or so, how many times can you picture yourself hearing over the years, I just want to make sure my family gets fair market for my business, right?
Yep.
Business is my biggest asset. It's what I've been working on for the last 3 decades. I want to make sure my family gets their fair share. How do you recommend presenting this concept?
Yeah, so I use it in context of personal planning. Most, every family who has children, they should have at a minimum a written will. And that written will tells them where assets go. Now, one key thing about a will is it is contestable. It can, come to the light of people taking you to court as a result of contesting that will. When we talk about planning and protecting families when it comes to business assets, having that well documented and current buy sell arrangement with updated value, it is what will hold up in court. So we talk about protecting families. Having a business continuation plan with a well funded, well executed buy sell arrangement, make sure that the people you care most about get the fair market value of the business because it's in the buy sell. They get it in a timely fashion because the buy sell dictates when those proceeds go. And the life insurance is there to fund that obligation. So there's no worry about a capital crunch. If we think about protecting a family from losing value in the business, having a well drafted and executed and funded buy sell agreement is the best way to protect your family in that situation.
Well said. Well said, and very practical. So, before we actually, Paul, we're not going to take questions from the audience because we have successfully answered several of them through the subject matter and our positioning of some of our panel questions. So, as a parting thought, before we let everyone go, what's one key takeaway you want every advisor to leave here with today?
Ask every center of influence and every business owner that you work with, when was the last time you had your buy sell agreement reviewed? And for those centers of influence, when was the last time you reviewed your client's buy sell agreement? And by asking that one question, if you get an answer that's within the past 6 months, that'd be very surprising to me. Odds are, if they haven't done it in the past year, they haven't done it at all. And that's going to be the takeaway from today is ask that question about, hey, we have this process. Let me have a second set of eyes on this agreement and let's share some ideas about best practices. So asking those business owners, asking those centers of influence about doing those buy sell agreement reviews, you will find opportunities to help your clients really improve their overall agreement, and we will find revenue generating opportunities as a result. So take that away as your call to action.
So the very first document, and 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 Paul, you're one of your associates, Tom Bates, taught me like 15 years ago. You get a copy of the buy-sell agreement. If the buy-sell agreement doesn't exist, you get a copy of the operating agreement and a two-page fact finder. It is not invasive. You're not asking for extensive amounts of financials. They don't have to engage with their CPA. They don't have to get undressed per se on the first date, which is probably a poor way of phrasing it, but it disarms the client, feels safe. They don't feel like you are probing into their business
Yep.
by asking for a copy of the operating agreement and or buy sell agreement. And to echo your thoughts there, Paul, get started with the buy sell review. It is the gateway to numerous opportunities. It provides tremendous value to the customer. It gains their trust. It allows you to bring together multiple centers of influence who also have clients that you may be able to serve. Fill out a fact finder and let us get to work for you. So at this point, Paul, we're 3 minutes over. I want to thank you for being with us. Amazing job. Even with, and Paul, no one even noticed your technical difficulties from your hotel room on your iPhone. Amazing job as well. At the close of this meeting, we're going to start getting together the white papers that you discussed, Paul, copies, PDF copies of the slides, and a recording of this webinar. The recording will also be archived at www.lifebrokeragellc.com in the blog section for your review in the future. Thank you so much for joining us. We appreciate your time, and please be well. At this point, our meeting is adjourned.
Thank you.
Thanks, Paul.